Friday's surprisingly robust jobs report put a damper on Wall Street's jumbo rate cut bets. According to the CME FedWatch tool, in just 1 week, investors have abandoned the idea of a 50 basis point cut in November, and nearly 15% are now predicting the Fed will leave rates actually unchanged at its next meeting. And our next guest says there's no case for another cut. We're joined now by Torsten Sløk, chief economist at Apollo Global Management, parent company, of course, of Yahoo Finance. Torsten, great to see you as always. Let's start, Torsten, state of the economy, that better than expected jobs report we did get, Torsten. I'm curious to get your take on that jobs report, what you made of it. What do you think the Fed made of it?
Well, I think that the economy is actually still doing quite well. The puzzle in financial markets, of course, is that the Federal Reserve started raising interest rates in March of 2022. And we're still sitting here 2.5 years later, and we still have not seen the negative consequences of interest rates moving higher. So that's why the debate looking ahead continues to be about, well, why didn't Fed hikes have this negative impact on the economy? And why is it that the data continues to still be so strong? And there are 3 reasons for that. First of all, we still have a strong tailwind from energy transition. We still have a strong tailwind also from fiscal policy. And we also still have a strong tailwind because consumers during the pandemic locked in low interest rates and firms locked in low interest rates. So the sensitivity to interest rates going up has just been relatively weak. So I think that the short answer to your question, Josh, is that the economic data is doing quite well. Inflation has come down. That's why the Fed cut rates. But going forward, if the economy is still doing well, that does raise some questions about whether we will see all the Fed cuts that the Fed is expecting at the moment.
Well, Torsten, you were one of the folks at the beginning of the year. You said they might not need to change rates at all, right? You might not see that much of a difference here. You have been talking about the strength in the U.S. economy. What about the argument on the part of the Fed that rather than sort of forestalling weakness in the labor market, they are cutting to normalize, to bring rates back to that sort of neutral level? Is that a valid reason to act? And you mentioned a little bit the risks that could come with that. Can you discuss that a little bit more?
No, you're right, Julie. I mean, it is correct that they used the justification at the last meeting that it wasn't really because the economy was weak. It was more that they were happy with where inflation is. And inflation has come down. It peaked at 9.1% in the summer of 2022. And now it's at 2.5%. So coming from 9 to 2.5%, that is certainly very impressive. And we have come a long way. But the key issue now is, well, if you begin to cut prematurely, it does, of course, raise the risk, in particular for reigniting a rally in the housing market. We're already seeing various indicators on housing beginning to show much more sign of life. And most importantly, the risk, of course, is if home prices begin to go up again. Housing has a weight of 40% in the CPI basket. We could also begin to see inflation begin to move higher. So that's why it's a very delicate balance that they are trying to walk here between, on the one hand, they do want the economic data to be good, but they also don't want inflation to begin to move higher.
Torsten, you mentioned inflation cooling. I want to talk about oil for a second here. I was talking with Julie at the top of the show about this move we're seeing, Torsten, geopolitical risk front and center. Does Israel hit Iranian oil facilities? The move higher we're seeing, Torsten, how as an economist are you thinking through that move and possible ripple effects?
Yeah, so for every $10 increase in oil prices, then inflation, depending on exactly whether you look at core or headline, but broadly speaking, inflation will go up by roughly 0.3%. So that means that the higher oil prices is absolutely going to lift inflation. Headline inflation will, of course, move more because it includes food and energy, but core is likely to also see some increase. So that's why it is certainly a risk on top of the economy beginning to show more strength, as we saw in the employment report on Friday. Most importantly, the unemployment rate moving down is also suggesting with strong wage inflation that we could even on the labor side see some upward pressure on inflation overall. So you're right, Josh. There's a number of different bullet points that are now lining up towards worrying before about, well, hey, maybe inflation is now coming down, to now worrying more about, well, maybe we're coming back into, in the worst case, the 2022 regime where rates were going up and stocks were going down. So in that sense, on Friday, the narrative for the U.S. economy changed 180 degrees from, hey, we're going through a slowdown, to now renewed fears about, well, maybe we should worry about a reacceleration.
Torsten, you mentioned that wage stickiness, and something I've been trying to get at with economists is Has it ever happened that wages have been rising and it hasn't had that much of an upward effect overall on inflation?
You're absolutely right, Julie. That basically never happens. So that's another way of saying, I mean, if we just think about the data, and also now we're about to go into the earnings season, if the data is still strong, if the earnings season is still strong, you can't argue that, oh, then the labor market is weak, but that's just a small thing. No, it must be the case if the economy is strong, then the labor market is also strong. If the economy is weak, well, then the labor market is also weak. And exactly as you're highlighting, if inflation in wages, which now came in at 4.0 on Friday, then we should also expect that to show up in inflation in consumer prices. It is really simple, as usual in economics, that it is really about consistency. What are we seeing in the mosaic of indicators that are coming in? And the mosaic of indicators that are coming, the totality of the data, as Jay Powell is saying, it is still telling us that inflation is not under control yet. And we still have this risk that the Fed will have to keep rates higher for longer, which continues to be our baseline scenario.